Welcome back, my friends, to another video of the Options Trading Masterclass. Here, my name is Andrew Ferguson. I run a small company called Trading Options Daily, where my main goal is to teach 10,000 investors just like yourself how to use stock options to live your dream life. Today, we're talking about something huge, something super important for options trading and any kind of stock investing overall. We're talking about how to pick great companies that act as assets and actually go up in time to make you more money. Let's get to it right now. Session number 5, we are going to build a watch list of companies, and the Fab 10, I'd like to call it. It's kind of a reference to the Fab 5 back in the Michigan basketball days. Shout out to Juwan Howard, Ray Jackson, Chris Webber, Jalen Rose, Jimmy King. If you're a basketball fan, you get that reference. But we're going to show you how to spread out your risk. And just spreading out risk is kind of like spreading peanut butter over a nice piece of toast. We want to take that Kraft smooth peanut butter, cover the entire area. We don't want clumps. We definitely don't want chunky peanut butter here. And finally, we're going to get into is how you know more than you think you do about stocks and find companies that you already are familiar with, which can be a huge asset for your trading. So my goal is to teach you how to take the blindfold off now and find and value good companies. Otherwise, you're always going to be like reliant on someone like me to pick something for you. And I don't want you to do that. It's not the path to success. I would love to give you recommendations, but I can't. It's education only here. You have to select your own investments. You have to make sure that they're good for you. Your portfolio is going to be different than mine. So here we go. Get into it. Lesson number 1, recruiting your own Fab 10. We want to start with the basics. We want to start where the bread and butter of companies are, and that is the S&P 500, the blue chip kind of swimming pool there. Start your list here. If you don't know what the S&P 500 is, it is the 500 biggest companies listed on the US stock exchange there. It is a great place to start. These are big, large cap companies that make a lot of money and have been around for a long time. So start there, find your tickers on the app, and add them to your watch list. What's a competitive advantage? Well, it makes it something that's hard or impossible to compete with a company that has one, because these type of companies just have so many things built up into their kind of system that you cannot replicate or compete with it. And these aren't recommendations for stocks. I'm just showing you examples for education. So Enbridge in Canada, where I'm from, they own all or most of the commercial and residential gas pipeline. So in Canada, like and anywhere, it takes an extreme amount of capital to build that infrastructure up. And they've done that over a period of decades. So they have a huge advantage owning that network that no one else can kind of replicate, because it's too cost intensive and there's no land to do it. Apple, you guys have heard Apple before. It's the largest kind of feedback loop in the world. They have their customers in this zone. They have the iPhone, the Mac, the Apple Watches, the smart apps. Like they all work together, AirPods. So they all work in that kind of ecosystem, and they have a better ecosystem for integrating people than anybody else. That's their advantage. And Walmart, another advantage they have is that they are the cheapest distributor. They have a network of shipping, of sourcing, of containing. Like they just have all this infrastructure built up already, that it makes it very difficult for other company to come and go and try to take their market share away, because they have just a monopoly and all those kind of things that they need to serve their product. So how do they make their money? This is a super important concept to understand, because when you're picking companies, you need to know how they get paid. And the thing is that they all have sources of income. You need to just kind of have a broad overview of what their money income is like, where they get it. For example, where does Disney make their money? Right? Are there multiple revenue streams for Disney? Sure, not another example, but they have Disney parks, Disney streaming, they have music, they have collectibles. Microsoft has software, they have gaming, they have cloud stuff, right? And the next thing you have to think about is who runs these companies and are they reputable? So a person like Elon Musk, let's say, are they successful? Well, he was involved in PayPal, he was involved in Tesla, he's involved in the internet company SpaceLink or Starlink and in SpaceX. And so just figure out like kind of who these people are, who the ones at the top are, and they have a history of success. So Elon Musk, who he runs Tesla, right? Do you have an idea who the CEO of GM or Ford is? Like that's what I'm talking about here. Like you understand who the successful people are. Success leaves clues. Do they make a lot of money? So this is just about revenue and net income for me. When I'm going through looking for kind of cash flow in the kind of the space where the companies make money, they need to see that they're bringing in money consistently every single year. If they're making more money and keeping more profit, which is net income, that's a good thing. You have to think about how much cash flow each company has. Like free cash flow is something that they have on hand in case something goes wrong. Like in COVID, they have cash in reserve to kind of float the company and make it kind of through the hard times. That's free cash flow they have. And then we also want to check and just see how is revenue increasing? Is it decreasing? Is it flat? So if the company's going through like a really high period of growth, revenue might be a little bit flat because they're kind of spending a lot to get to where they need to go. But then Hopefully that's going to increase in the future when they have more kind of sales staff, more leads, more customers. And then obviously you don't want to be kind of investing in a company that has decreasing profits. But you can't just set and forget these companies. You have a watch list, right? And things change in business all the time. You have to be ready to kind of go and understand that executives go, products kind of flop. There's recalls, lawsuits. You have to kind of check the news a couple times a day just to keep your eye on things. But remember, when we're doing this, and I've said it in other parts this series. So if you want to check out the whole series, the card for it's right there. But you don't have to check your phone more than 30 minutes a day. That's the whole point of this. And it's just set it and forget it. But no, it's not. Just check it in the morning, check it in the afternoon, check it in the evening, and then you're good, like a couple times a day. So when you want to do some homework here, you need to just kind of have a list of companies for just an idea of what you want to invest in. Just build a list of 5. Like just have 5 companies that you think about investing in. And a great place to start to do that is the Yahoo Finance. So I do this for my trading, and I do this just because it's easy, it's free. And if you go there to yahoofinance.com, you can actually put a ticker in the top here and search for it. And this Tesla's stock has split since then. This is a crazy outdated price, but it shows you the summary, the chart, the conversations, the stats, the financials is the big thing right there. And you can go through all this information for free on Yahoo Finance. So check that out. I'll put a link in the description below for that website. Part number 2, how to actually spread out your risk. And just, you don't want to go all on one company. So the idea here is that if you're at the poker table, we don't want to be the gambler. We don't want to put everything in one stock or one company. We want to kind of spread the risk around and portfolio manage risk. And we want to do that by risk kind of spreading out in different sectors. And then we just kind of master our own approach, right? We want to make sure we're doing this ourselves, not following the guide of some kind of stock guru or even myself. You have to invest on your own situation because you don't know how much kind of capital someone else is working with, their experience, what they know about the company. So you have to kind of do it for yourself. That's why I preach kind of self-education here. But there are 11 stock sectors here, and you have to have a solid mix of not all of these per se, but you want to have a bunch of them, right? You want to have maybe 5 or 6 different stocks, different sectors in your portfolio. And just here's an example that we can break it down by sector of what kind of a example portfolio would be. So you have a lot of information tech, 25% with those companies, 25% communications, 25% financials, consumer discretionary, and then consumer staples. So that would be like a moderately balanced portfolio. You have 5 different sectors there. Maybe you want to add in a little bit of real estate. Maybe you want to add in a little bit of healthcare. It's up to you. But the idea is that you have to spread out some risk. You don't want to go all in on one sector, because if that sector craps the bed, well, you're holding a big steamy pile of crap then, and then you don't want to do that. And it just takes longer for you to recover. And you kind of just beat up yourself a little bit and think about, did I do this right? Did I do this wrong? I should have managed risk a little bit better. We also have to think about seasonality when it comes to the stock market, because just like the seasons that we have, winter, spring, summer, fall, we have seasons in the stock market where there's times that are better to invest than others for different sectors, for different companies, for the market in general. So we have to think about seasonality. This is a good concept to get a grasp of. So things like the Santa Claus rally is a real thing. For example, at the end of the year, November and December are historically the 2 best months of the year for the overall market. There's also a heavy kind of boom in the stock sector around the Santa Claus rally because people are spending for the holidays. A lot of corporations are kind of ending up with their budgets. They're kind of getting all the money off the table, and then their new budgets kick off at the beginning of the year. So they're trying to get all that money into the system, get new products for their employees. So the Santa Claus rally is a real thing. Just one example of seasonality. If you want to do your own research into it, there's a free online tool you can use. It is called equityclock.com. I'll put the link for this in the description of this video as well. And I'll also give you my own seasonality kind of pack in the bonus here in the description for this video as well. It's my personal seasonality guide of a bunch of companies that I look for, and just times where they perform really well and times they don't perform as well. So you kind of plan your trades around seasonality as well, and understand that it's not a guarantee, but it kind of just helps kind of give you an advantage potentially at those times of the year. We're also talking again about volatility in the VIX. We touched on this in session number 1, talking about the stock market basics, but we're getting back into it now. So VIX, if you recall, it is the fear and risk index of the markets. And when volatility is out there, it's actually something you can track in your kind of app or in your trading chart on your watch list. Low volatility is anywhere from 0 to 12, neutral 12 to 20. That's where it likes to hang out. And high is 20 plus. And if we look at the VIX on the chart, it is a total opposite of the actual stock market. So when you see the VIX kind of spike like that, it means that the market sold off like crazy. And that actual spike there that's showing, coincides with the S&P 500 dropping drastically during March of 2020 when the lockdown started and the world kind of shut down. If we go and flip to the S&P 500, which is like the main kind of shot of the market, this will be an inverted chart. It'll flip over 180 and you'll see it like this. So you can see that point right there is exactly when the VIX spiked, right? We go back and boom, it spiked, and then the market sold off, and then it kind of went back to normal, and the VIX went back to normal as well, and kind of went back to that 20 range. So the VIX is something that we want to use because we want to earn more premium, and we have to understand that if there is higher VIX and higher volatility, we have a higher chance of being assigned shares. But because of that, which is the sweet part here, we get paid more money, more premium for selling our puts. And we still want to focus on the good quality companies that we talked about how to find them earlier in this lesson, but we want to understand that we're getting paid more when volatility is high, which is a good thing. So there's actual volatility in the market, and there's actual volatility in each stock, which is known as the implied volatility, or IV. And that number gives you a snapshot of how volatile the price movement for a stock will be. And some companies are different than others. So you have to understand that IV changes per company. For example, this is a good one. So in this kind of example, we have Airbnb on one side, Nike on the other, okay? And there is a difference in implied volatility for each company. Both stocks trading with a similar stock price, using the same strike price of 155 and a delta, which is right around 25. So a 25% chance of having to buy shares on either side, right? So we have a roughly 75% chance of winning both trades here, but you get paid over $100 more to sell an Airbnb put. Now, I'm not saying that that's the choice to make here because IV is higher, but understand that when you look at the IV, it's going to increase the premium on one of these kind of companies where it's kind of keeping the other one a little bit lower. So if you want to kind of scale up your returns a little bit, look for a little bit higher IV, make sure it's a good company. If you want to kind of play a little bit more safe, look for a little bit lower IV, but understand you're getting paid a little bit less. So it's up to you, your personal preference, but I like that both companies have a 25% chance of getting assigned shares, which is right in our sweet spot, and it hits the rule of 100 as well, where the returns are very good right now for both these trades in this example. And portfolio, like your actual collection of portfolio and stocks, needs to have risk spread around in terms of stable companies that aren't going to blow you away, but they're not going to kill you. And you have a couple that are sprinkling that a little bit more kind of IV, high IV, that's okay too. But we want a mix of both. We want a mix of kind of a little bit of volatility, a little bit less volatility, and kind of hit the sweet spot and kind of just, it's about diversification and spreading it around, right? So here's what we want to do. We want to consider your sectors when you're allocating your investment. The 11 that we showed you, there's 11, pick 5 or 6 and go from there. We want to understand where the seasonal periods of strength are for companies. And we understand that there's a good mix of volatility. And that's kind of where the money spot is when we can combine those 3 things and put them all together. That's where we kind of make the biggest bang for our buck when we're selling put options. Now, lesson number 3 here. We want to understand and get a head start on the competition, on ourselves. We may not think that we know a lot, but you do know. You do know quite a bit about stocks, and there's things that you kind of just have to think about in a different way. And we'll unlock that right now. What companies do you use every day? I'm talking about every single day. Is there something that you kind of go through the motions and you're kind of using without even kind of thinking about it? So there's probably more than you thought. And where do you go to get coffee in the morning? Do you have a favorite place for lunch? Do you use a certain kind of smartphone? These are all different kind of products and interactions that you use every day. What kind of car do you drive? That's the kind of thing I'm talking about. You have a competitive advantage, know what the products are, know how they make money without even thinking about it. It's on autopilot, right? You just use it without even knowing. Now you can actually use it and apply it to make you money potentially. So what companies also do you see coming more prevalent day to day? Like Airbnbs have popped up recently, right? They're kind of a new kind of emerging trend disrupting the hotel business. Uber is a good one. PayPal for online payments, Amazon for shopping, Tesla for EV cars. There's a trend coming for a reason. That's the biggest thing here. There's a trend for a reason. So don't discredit the trends. If you're seeing more and more of these kind of things, more Teslas on the road, that's a trend that's happening for a reason. Get on board, understand it, dig into it a little bit more. What kind of field work are you in? Like, do you understand that, like, if you're in construction, maybe you're going to see all the machines on site and you know that Caterpillar is kind of the provider of those machines. That's great. If you're in an office setting and you're kind of using Microsoft for your programming and your computer, that's a good company to know right there. If you're a gamer, right, maybe you can understand like a crap game for a great game and understand like who makes it, who designs it. Is it Activision Blizzard? Is it, I don't even know any more gaming companies besides that. I'm not a gamer, but are there gamers that make the chips for gaming like AMD or NVIDIA or just different things like that? So Intel. But you understand those kind of companies because you use those products day to day. And this gives you an advantage. Okay. This is you having your finger on the pulse. And just if you take it and kind of think about it critically, you can kind of just get ahead of other investors out there and understand these companies, because you understand how they make money, you understand their products, you understand what they do. And you just have to understand that if you read the news on top of that and check their earnings, what you're ultimately doing is this. You tilt the odds in your favor. You make it a little bit more of a competitive advantage for yourself to make great trades on good companies at the right time. And you have your kind of background knowledge to kind of back that trade up. So that's how you kind of do it. That's how you understand fundamental analysis of picking companies. And now at this point, out of this first kind of 5 videos, you guys understand the basics of the stock market. We went through that. We went through what the stock market is, what a stock chart is, how it works, how options work. You understand how I sell put options, how you can sell put options, and kind of understand how you can kind of use kind of these guidelines, 80% rule, checking your delta, checking the rule of 100, rotating your capital to understand how to make great trades. We went through technical analysis the last session here, understanding the chart reading, and then you have the fundamental analysis and company picking right now. So you have everything you need to get started. The only thing that you probably don't have at this time is an understanding of how to use an app like Interactive Brokers. But that's okay, because I got you. Make sure you tune into this next video right here, because I'm going to show you step by step how to open up your app, how to fund your account, how to get money in there so you can start trading. Or if you want to trade with a paper account and trade free money, fake money, so you make mistakes, it doesn't matter. There's zero risk here. Make sure you check out this next video coming up right at you right here.